The crisis of credit. A credit crisis occurs when borrowers default on their loans, making financial institutions that issued loans stop receiving their payments. This is followed by a period in which financial institutions redefine the riskiness of borrowers, making it difficult for debtors to find creditors. A financial system is the system that enables lenders and borrowers to exchange funds. The global financial system encompasses all homeowners, lenders, investment bankers, and investors. The first sector of the financial system is made up by homeowners. The homeowners sector is made by many individuals that buy their homes by buying mortgages, which are loans made by banks for them to be able to buy their homes. They are obligated to pay a monthly fee for the loans to the bank. The second sector of the financial system is made up by lenders. A lender is someone who makes funds available to another, which the expectation that the funds will be repaid, plus any interest or fees. A lender can be an individual or a public or private group. Lenders provide mortgages to homeowners or leverage to financial institutions. Investment banks are specialized in a large and complex financial transactions such as underwriting, acting as an intermediary between a security issuer and the investment public, facilitating managers and other corporate reorganizations, and acting as a broker and or financial advisor for institutional clients, including lenders. The fourth and last sector of the financial system is made up by investors. An investor is a person who commits capital with the expectations of financial returns. Investors utilize investments in order to grow their money or provide an income during retirement, such as with an annuity. Investors are the individuals that provide the capital for investment banks. The financial system works in the following way. The lenders sold their mortgages, from which they received monthly payments from the homeowners, to the investment bankers, and the investment bankers sold the mortgages to the investors. The first cause of the financial crisis is the selling of subprime mortgages. A subprime mortgage is a type of mortgage that is normally made out of borrowers with lowered credit ratings. As a result of the borrower's lowered credit rating, a conventional mortgage is not offered because of the lender views and the offers as having a larger than average risk of defaulting on the loan. The problem was that when a homeowner defaulted on their mortgage, the investment bankers, lenders, and investors stopped receiving the monthly fee. Therefore, no one else wanted to buy mortgages and no one else wanted to give out mortgages. Therefore, the market froze. The second cause of the financial crisis were the collateralized debt obligations. A CDO is a type of structured asset-backed security, originally developed for the corporate debt markets. Over time, CDOs evolved to encompass the mortgage and mortgage-backed security markets. The problem with CDOs was that the asset that backed the document lost its value and caused investors to lose all their money. The third cause of the credit crisis was the frozen credits market. With the lack of current confidence in our financial system, a credit and lending freeze was descended, with few banks feeling comfortable enough to extend credit to individuals or businesses. An extended freeze may result in layoffs and other drastic measures. The first consequence of the financial crisis was that the investors there began to avoid risky assets in favor of ultra-safe U.S. Treasury securities. Not only did this sharp increase cause large losses for many banks and investors, but it also reflected much higher borrowing costs for companies wishing to raise capital. The second consequence of the financial crisis was that the US, Europe, and Asia saw major stock market declines, but some markets such as Hong Kong and Russia fell even farther. In other words, investors seeking refuge from falling markets found nowhere to hide. The most dangerous consequence of the credit crisis was that this trust began to erode as investors questioned the solvency of banks and other financial institutions. This erosion of confidence ate away at a very at the very foundation of the modern financial system. Another effect of the financial crisis was that poverty had risen dramatically in the suburbs, which, according to the Brookings Institution in Washington, D.C., are now home to nearly a third of the nation's poor. This phenomenon is worst in and around cities such as Michigan, Youngstown, and Ohio, but it exists nationwide. The days of 5% unemployment fell behind. Currently, the jobless rate stands at 9.6%, after rising above 10% in 2009. Economists believe that the rate will spike again, peaking to 10.75% in the middle of 2011. Whereas just about anybody could get a credit card or be approved for a credit card and a mortgage before the economy crattered, now even people who are well qualified to borrow are having a hard time getting approved. Some estimates say about 1 in 10 applications are accepted. Another consequence is that life is harder for the middle class than before. A major indicator of this is that about 6 in every 10 Americans now say that they are always and usually live paycheck to paycheck, compared to 49% in 2008 and 43% in 2007. In 2009, the number of Americans who filed for bankruptcy was of 1.4 million, 32% more than in 2008. Finding a job takes longer nowadays too, on average 35.2 weeks, and 40% of Americans who have a job work in lower paying services occupations.